Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. Inflation and rising interest rates have resulted in a rise in financial market volatility this year. But even while markets are challenging, there are always opportunities. So this is the second of a two-part series. Last week we talked about income-producing strategies, and this week we're going to actually talk about hedges to the portfolio. So we have chartered financial analyst and one of Lineweaver Wealth Advisors' portfolio managers, Travis Dragan, with us. So where should we get started?
Well, one approach to consider is a buffered ETF strategy. So a buffered ETF seeks to track the performance of an underlying index, most commonly the S&P 500 index, but it buffers investors against the first 15% downside over a 12-month period.
Yeah, so if the S&P 500 is down, say 10% in the next 12 months, a buffered ETF holder would be flat minus the expenses of the ETF. However, if the S&P 500 is down 20%, a buffered ETF holder is only down 5%, but if they renew it for another year, they will be buying back into the market at the lower 20% down of the S&P 500.
Right, but it's important to keep in mind the cost of receiving that downside protection is a cap on upside participation, meaning that a buffered ETF investor may only participate in the S&P 500's upside to a certain extent.
Yeah, and we've seen them in recent months as high as like 22%, however, compared to a year ago when they were only 9 to 10%. So these also trade like a stock, so they can be sold at any time, and the ones we're referencing here have a one-year maturity. So if you want the full potential, you are going to have to hold it for the full 12 months.
Right, and another similar hedge is an equity index annuity, or EIA. And just like buffered ETFs, EIAs seek to protect on the downside, but similar to buffered ETFs, you'll also be capped on the upside.
Yeah, and annuities can be very confusing for people, and you really want to know the ins and outs before you buy one. So unlike buffered ETFs, annuities usually are not liquid, and they usually limit access to your money to, say, only 10% per year, and they usually have 5, 7, or 10 years, or even longer surrender charge periods.
Right, and both strategies seek to protect against the downside, dampen volatility within investment portfolios, but maybe most importantly, to remove the emotions from the investing equation to avoid buying high or selling low.
And it could be tempting to try to go to cash and try to time the market and figure out when to jump back in. The problem is you're never going to know until you're looking in the rearview mirror.
That's exactly right. And according to a Market Guard study, only 1.8% of portfolio returns actually come from timing the market.
And you bring up a really good point because we added energy to most of our portfolios back in early 21 and it has worked out extremely well. That's why proactive money management, along with some of the income opportunities that we talked about last week and the hedges that we talked about today, can provide people with a very diversified portfolio to help them reach their retirement goals. So if you'd like to learn more about how you can add this strategy and some other ones that we talked about to your portfolio, or if you'd like a no obligation second opinion, give us a call. Thanks and stay tuned for Fox News Sunday.